Well, good morning, everyone. Bonjour tout le monde. Welcome to the Bank of Canada and today's press conference about today's interest rate announcement. Le gouverneur Macklem va prononcer une déclaration préliminaire.
Governor Macklem will make an opening statement, and after that, we will turn to your questions.
Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions until about 11:15 or so. Cela dit, je donne la parole au gouverneur Macklem.
Turning it over to Governor Macklem.
Good morning and welcome. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss our policy decision. Today, we lowered our policy interest rate by 25 basis points to 2 3/4%. The Canadian economy ended 2024 in good shape. Inflation has been close to the 2% target since last summer. Substantial cuts to our policy interest rate through the second half of last year boosted household spending and strengthened economic growth. However, in recent months, the pervasive uncertainty created by continuously changing U.S. tariff threats have shaken business and consumer confidence. This is restraining household spending intentions and businesses' plans to hire and invest. Against this backdrop, and with inflation near the 2% target, the Governing Council decided to reduce the policy rate a further 25 basis points. Looking ahead, the trade conflict with the United States can be expected to weigh on economic activity while also increasing prices and inflation. The Governing Council will proceed carefully with any further changes to our policy rate, given the need to assess both the upward pressure on inflation from higher costs and the downward pressure from weaker demand. L'économie canadienne a fini 2000.
The Canadian economy ended 2024 in good shape. Inflation has been close to the 2% target since last summer. Substantial cuts to our policy rate through the second half of last year boosted household spending and economic growth. However, in recent months, the pervasive uncertainty created by continuously changing U.S. tariff threats has shaken business and consumer confidence at this time. The result is that this is restraining household spending intentions, as well as businesses' plans to hire and invest. Against this backdrop, and with inflation near the 2% target, the Governing Council decided to reduce the policy rate a further 25 basis points. Looking ahead, the trade conflict with the United States can be expected to weigh on economic activity while also increasing prices and inflation. Governing Council will proceed carefully with any further changes to our policy rate, given the need to assess both the upward pressures on inflation from higher costs and the downward pressures from weaker demand.
So let me expand on these considerations. Economic data since our January monetary policy report suggests the Canadian economy ended 2024 on a stronger footing than we expected. Past interest rate cuts have boosted consumer spending and business investment, increasing domestic demand in the fourth quarter by a robust 5.6%. Overall, GDP grew 2.6% in the fourth quarter after upwardly revised growth of 2.2% in the third quarter. This growth path is considerably stronger than we were expecting based on the information we had in January. Job growth also strengthened around the end of the year before stalling in February. Growth in employment increased in November through January, surpassing labor force growth, and the unemployment rate declined to 6.6%. There are also signs wage growth is moderating. Inflation has remained close to the 2% target. The temporary GST-HST holiday has lowered some consumer prices, but January inflation came in a little firmer than expected at 1.9%. Inflation is forecast to increase to about 2.5% in March with the end of the tax break. Today, we published new survey data on what we are hearing from businesses and households. While it is still too early to see much impact of new tariffs on economic activity, our surveys suggest that threats to new tariffs and uncertainty about the Canada-U.S. trade relationship are already having a big impact on business and consumer intentions. Canadians are more worried about their job security and financial health as a result of trade tensions, and they intend to spend more cautiously. Job security concerns increase particularly among workers in export-oriented industries, including manufacturing, mining, and oil and gas. Businesses have lowered their sales outlooks, notably in manufacturing and in sectors that depend on discretionary spending by households. Credit has become more difficult to access for some businesses, and with a weaker Canadian dollar, the cost of imported machinery and equipment has risen. As a result of all these trade-related factors, many businesses have scaled back their hiring and investment plans. Our surveys also suggest business intentions to raise This recent shift in consumer and business intentions is expected to translate into a marked slowing in domestic demand in the first quarter of this year. At the same time, merchandise trade data suggests businesses on both sides of the border have stocked up on imports in advance of tariffs. As a result, Canadian exports and imports are both expected to be stronger than expected in the first quarter. But the impact on exports looks to be bigger, which should provide some offset to weaker domestic demand in the quarter. Of course, this pull forward in exports likely means weakness ahead. If household and business spending intentions remain restrained, the combination of weaker exports and softer domestic demand would weigh further on economic activity in the second quarter. The impacts of uncertainty and tariffs on inflation are more difficult to assess. Uncertainty that weighs on household and business spending tends to put downward pressure on inflation, and new tariffs will hurt our exports and weaken business investment. But costs are rising too, and this will put upward pressure on inflation. A weaker Canadian dollar and new retaliatory tariffs both make imports more expensive. Businesses are also telling us that uncertainty itself has costs. It will take some time for the impacts of higher costs and weaker demand to work their way through the economy and affect the prices that Canadians will face. Governing Council will be tracing the impact of cost pressures through to consumer prices. We'll also be closely monitoring inflation expectations. Keeping medium and longer-term inflation expectations well anchored is imperative to ensure that any rise in inflation is temporary. Let me wrap up. À la fin de 2024, l'économie était.
We ended 2024 on a solid economic footing, but we're now facing a new crisis. Depending on the extent and the duration of these new U.S. tariffs, the economic impact could be severe. The uncertainty alone is causing harm. Monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. The focus of Governing Council will therefore be on assessing the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time.
We ended 2024 on a solid economic footing. We are now facing a new crisis. Depending on the extent and duration of new U.S. tariffs, the economic impact could be severe. The uncertainty alone is already causing harm. Monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. The focus of the Governing Council will be on assessing the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time. And with that, the Senior Deputy Governor and I will be very pleased to take your questions. Thank you.
Okay, thank you, Governor. We will go to questions now. We'll start with the reporters here in the room in Ottawa, after which we'll go to those who have joined us remotely. We've got some work to do to get to everybody, so I'm going to ask you to limit yourself to one question only so that we can try to get to every outlet. If I forget to do so, please state your name and affiliation. And we have a few new folks with us here today. Please, in the room, please press the green button on the microphone in front of you to ask your question and activate your microphone. Press it again to shut it off once you're done. Please try to speak directly into that microphone so everybody can hear the question. Avant de poser une question, veuillez-vous...
Before asking your question, please identify yourself. And you are, of course, free to ask your question in the official language of your choice.
Mail.
Mark Randall du Globe and Mail.
Thank you very much, Governor, for taking the question. You talk about the potential inflationary impacts of trade war, whether that's retaliatory tariffs, depreciation. What kind of inflationary impact are we talking about? And do you view that as a one-off jump in price level, or is this something that could feed through to inflation? How are you kind of gaming that out?
Well, Mark, first of all, given the pervasive uncertainty and the unpredictability of U.S. trade policy, I can't put a number on it. The scenario is changing every day with new announcements literally every day. In terms of the channels, though, we, in the monetary policy report, in my speech in Mississauga, we were very clear in identifying a number of channels. The Canadian dollar has depreciated. If you're a business importing machinery and equipment, if you're importing goods from the United States, a weaker Canadian dollar means they're going to be more expensive in Canada. Obviously, retaliatory tariffs puts an extra charge on U.S. goods coming into Canada. That adds costs. The other thing we're hearing from businesses is that the uncertainty itself is adding costs. Businesses are looking for new suppliers. They're holding extra inventory. They're looking for new markets for their goods. That all entails new costs. So there are a number of new costs that businesses are facing, and ultimately those will get passed through to the prices the Canadians face. There's quite a bit of uncertainty about how quickly that happens. Does it get fully passed through? How quickly does it get passed through? So those are things that we are going to be doing our very best to trace. We have data on, we have CPI data, we have micro CPI data, we have data when goods cross the border. So we should be able to do a fairly good job of tracing how these things are working through the economy. What we don't want to see that first round of price increases have knock-on effects causing other prices to go up, that becoming generalized and ongoing inflation. That's what we can't let happen.
Okay, our next question is from Pramit Mukherjee of Thomson Reuters.
Good morning, Governor. Governor, while you have said that the Governing Council will proceed very carefully with further changes to policy, your comments indicate a kind of hawkish stance. And there are, of course, a lot of inflationary pressures everywhere. Do you think there's a possibility of a hike also somewhere in the future?
Look, the reality is there's a lot of uncertainty. And against that background, we can't provide forward guidance. Look, what I can tell you is how we're thinking about monetary policy in the face of a trade war and what we're particularly focused on. So let me start with the first one. How are we thinking about it? We've been very clear, monetary policy cannot offset the impacts of a trade war. We're going to get weaker economic activity, we're going to get higher prices, higher inflation. We can't change that. What we can do is ensure that any rise in inflation is temporary. And what does that mean? What it means is we're going to do as much as we can to help the economy adjust to the painful adjustment to higher U.S. tariffs. But what we can do is limited by the need to control inflation. We can't lean against weaker growth and higher inflation at the same time. So what are we focused on? I'd highlight two things. First of all, and I discussed this a bit in response to Mark's question, we're focused on assessing the upward pressure on inflation coming from new costs and the downward pressures on inflation from weaker demand, both external demand and domestic demand. We're going to be doing our best to try to trace how those costs are working through the economy to the final goods prices that households face. That's, it's going to take some time for that to work through. The other thing we're focused on is inflation expectations. It's going to be critically important that medium and longer term inflation expectations remain well anchored. When that happens, any increase in inflation will be temporary. Inflation will come back to target. So those are the two things that we are particularly focused on.
We'll go now to Mackenzie Gray, please.
Hi, Governor. Your colleague in the U.S., Jay Powell, has talked about how it's yet to be seen if the tariffs will be inflationary. The Trump administration has been very clear. Howard Lutnick has said that he does not think the tariffs will be inflationary. Can you just explain why you believe you think the tariffs will be inflationary and what you make of the fact the U.S. administration has been adamant that this will not increase inflation?
Well, look, I'm going to let the U.S. administration speak for themselves. We've been very clear. There are two effects of tariffs on inflation. Tariffs are going to weaken the Canadian economy. They're going to weaken U.S. demand for our exports. Americans have to pay those tariffs when they import our goods. That's going to reduce their demand for our exports. So our exports to the United States will be weaker. Certainly what we're hearing from businesses is that is having an impact on their investment plans. They're scaling back their hiring intentions. So that's going to spill into the domestic economy. It could well mean layoffs. Certainly what we're hearing from Canadians that they are becoming more worried about their job security, particularly in export-oriented sectors. That, of course, means that they're becoming more cautious in their spending, so domestic demand will also slow. That will all put downward pressure on inflation. But as I outlined earlier, there are a number of direct cost pressures involved with tariffs. The Canadian dollar is depreciating. Anything you import is more expensive as a result. Retaliatory tariffs add an extra charge on anything coming in from across the U.S. border. That increases costs. Businesses they're also looking for new suppliers to avoid tariffs. They're looking for new markets. That entails costs. There could well be supply chain problems. Businesses are holding more inventories to try to manage those things. These things all have costs. Somebody has to pay for those costs, and ultimately they get passed through to the consumer. So it wouldn't be surprising if you saw some increase in inflation as those costs get passed through. What we're doing is we're focused on weighing those downward pressures and those upward pressures. Our job is to maintain price stability, and that's what we're focused on.
Okay, I'll go over here now to Jordan Gowling from the Financial Post, please.
Hi, Governor. The surveys you published today say 40% of businesses plan to pull back on hiring. There are talks of potential layoffs in export industries. So what do you anticipate that's going to do to Canada's unemployment rate this year? How much do you anticipate it's going to rise?
Well, I don't have a forecast for you. I think in terms of what we're expecting to see in the first quarter, so as I mentioned, fourth quarter, very strong, 2.6% growth. We expect the first quarter to be weaker. We actually expect domestic demand, so consumption and business investment, to be quite a bit weaker in the first quarter than it was in the fourth quarter. We expect it to be quite weak, frankly. We do expect some offset on first quarter GDP growth, because what we've seen is we've seen a surge in exports as businesses try to get ahead of the tariffs. So first quarter, we think domestic demand will be very weak. We think exports will be up. GDP growth will be weaker than it's been, but probably not that weak. Going forward, though, of course, if you pull exports forward, that means you're going to get less exports in the future. So if household demand, if business investment remains restrained in the second quarter, and you'll likely see weakness in exports, you could see an even weaker second quarter. So yes, I would expect if that plays out, you'd see some rise in the unemployment rate.
Okay, now I'm going to call on Judy Trin from CTV, please.
Hello, Governor. I am wondering, you use the word crisis. That's a strong word. You don't usually see it coming from the Bank of Canada, but you did not use the word recession. Is a recession imminent? Do we have to tell Canadians that we need to brace? And also, how do you feel about a former bank governor now leading the nation in terms of its negotiations during a trade war?
Those are two pretty separate questions. Why don't you take the first one? I'll take the second one. That's a good idea.
Well, Judy, we don't have a forecast at this decision. We've put out, unusually we put out our survey data ahead. Usually we package it up with our forecast as sort of a complement to the projection that we provide. We put it out today because we promised you at the last decision that in this environment of high uncertainty, we would do our very best to keep Canadians up to date, help them understand how we were thinking about the economy, how we were thinking about the situation we were in, and what kind of data we were looking at. So we've stepped up our outreach to Canadians. The survey data is an example of that. We put it out, but it's not meant to provide a forecast on either output or on unemployment, as the previous question. So we don't have an economic forecast right now. What we do take from what we're hearing from Canadians is the sentiment has turned quite sharply. The economy came in quite strong at the end of last year. That would have been really good news. But for this large cloud of uncertainty hanging over the economy, what businesses are telling us is they're slowing investment, they're slowing hiring. Canadians are saving more, spending less. So all of those things don't bode well for growth, but we'll see. We'll have a forecast at our next decision.
I mean, the short answer to that question is it's going to depend a lot what the U.S. does with their trade policy. We'll have to see. Regarding your second question, I don't have much to say. Look, as you said, Mark Carney and I worked together here at the Bank of Canada. He was the governor. I was the senior deputy governor. Mark has now entered politics. The Bank of Canada operates independently of the political process. That is really important. And what that means is it comes with a responsibility. The Bank of Canada needs to stay clear of any comments that could be seen as political in nature. So I have no further comments. I'm not going to be commenting on political leaders or political developments.
We'll go now to Pam Almeida from Market News, please.
Good morning, Governor. My question is, did you consider cutting interest rates by 50 basis points? And if so, did you consider whether cutting rates by more than 25 basis points could have made things worse by adding to uncertainty or a loss of confidence among Canadians?
I mean, you're going to get the summary of deliberations in a couple of weeks, so you're going to see, you're going to get more details on our deliberations. But I mean, the short answer to your question is we did not seriously consider a cut of 50 basis points. And why is that? Well, monetary policy does need to be forward-looking, and what we see from the hard data so far still looks good. You can't see much of damage from the trade war in the hard data yet. But when you look at the survey data, it's pretty clear. Consumer confidence, business confidence has been sharply affected, and we are expecting to see a pullback in household spending and business investment. That's going to have an impact in the economy, and that's really why we decided to cut 25 basis points. Monetary policy does need to be forward-looking, but there is a lot of uncertainty. This is a very fluid situation. There is a lot of unpredictability in terms of what the U.S. is going to do. And, as we've outlined time and again, a trade war, yes, it weakens growth, but it will also increase prices and inflation. We've got to be very careful to balance those two. So against that background, we did not want to get ahead of ourselves. And we're going to be assessing these things carefully. That's going to take some time. And our message really is that we will proceed carefully with any further changes to our policy rate.
Okay, next I'm going to go to Paul Vieira from the Wall Street Journal, please.
I know, I'm aware that the Bank of Canada does not target for foreign exchange rates. However, the communications does talk about the impact of the Canadian dollar on a weaker Canadian dollar lifting prices. Will Bank of Canada officials be more sensitive about movements in the Canadian dollar when it comes to future rate decisions?
Well, Paul, the Canadian dollar has certainly moved down largely as a result of the continuing tariff threats. It's actually been, it's been volatile day to day, but it hasn't changed that much since our last decision. Obviously, as the market keeps getting new information, new statements out of the U.S. administration, you're seeing some volatility in the dollar. But overall, it hasn't changed much since our last decision. The Canadian dollar is reflecting what's going on, and it's moved, and that's something that we need to take account in our decisions. To some extent, it's a shock absorber. It will help the economy adjust to some extent. It offsets some of the impact for exporters, or at least some exporters, depending on the nature of their business, not everybody. It also affects the costs that businesses and Canadians are facing when they buy goods from the United States. So yes, we need to factor that in. And when something's moving, yes, it gets more attention. So that is something we'll look at, but we're going to look at it in the context of everything else that is going on.
Okay, next I'm going to go to the back for Craig Lord of Canadian Press, please.
Good morning. How much of a role do you think Canada's own retaliatory tariffs will play in the economic shock and the inflation shock compared to the U.S. actions?
Yeah, I mean, retaliatory tariffs are going to add to the uncertainty. They're going to add to the potential price increases that Canadians and Canadian businesses face. There's really no question about that. But these are really tough decisions. They're decisions that don't belong to the central bank. They're trade policy decisions, and they're made by the government. And I'm sure they're not easy decisions to take, but governments need all the tools they can get in a trade war. I mean, retaliatory tariffs are really designed to try and get us back to a mutually beneficial trading relationship. That's a goal we all want. So, but yeah, they're gonna add in the near term, certainly to the uncertainty and to the effects.
Okay, I've got 3 left here in the room before we go to the phones. I'll call on Daiichi Mishimi from Nikkei, please.
Thank you. Thank you for taking my question. I just want to follow up on the former question about the effects. while I understand that you don't target currency rate itself, do you think that depreciation of the Canadian dollar has a stronger impact on economic activity than the traditional pass-through, where cutting rates boost investment and consumption?
Thank you. Look, certainly in an open economy like Canada's, you know, part of the way monetary policy works is through the exchange rate. And I mean, you have to abstract a bit from the current situation, but you know, in a normal situation, when we cut interest rates, that tends to depreciate the Canadian dollar. So when you cut interest rates, that supports domestic demand, that lowers the cost of credit for businesses, for Canadians borrowing, that tends to stimulate domestic demand. The depreciation of the exchange rate tends to make Canadian exports more competitive, and so that boosts foreign demand. So they both work in the same direction, and you know, that's part of the way monetary policy works. As I said, the fact that we've been lowering interest rates has had some effect on the Canadian dollar. I think if you look at the timing of the effects and the magnitude, our assessment is that they're more related to the uncertainty and the trade actions created by the U.S. government. But yes, that, you know, as I said in the previous question, the exchange rate is operating as somewhat of a shock absorber. It's certainly not perfect, and it has some cost consequences as well, and we'll have to take that into account along with everything else as we move forward.
Okay, Randy Thantong Knight from Bloomberg is next.
Hi, Governor. How would you characterize the current level of interest rates? Would you call it neutral, or is it slightly stimulative?
Well, there's always a lot of uncertainty about exactly where neutral is. We do our best to estimate neutral, and we have a number of different approaches to do that. We do that once a year. I think the next meeting we will be, at our April meeting, we will be having another look at that. Right now, actually, our estimate of neutral is centered on 2 3/4, which is where we are. What we actually put out is a range reflecting to try to give some idea of the uncertainty. But yes, I think the Governing Council thinks of us as in that neutral range.
And last here in Ottawa is Kevin Carmichael from The Logic, please.
Good morning. Household debt in Canada is extremely elevated. Public debt is elevated. Markets are volatile again. The President of the United States is musing about defaulting on debt. Could you talk a bit about how financial stability is factoring into your thinking right now?
Yeah, we saw that particular musing concerning. I mean, we'll have our financial stability report out in May, Kevin, and so we'll dive a bit deeper then. But we're seeing the markets, the equity markets in particular, in recent days start to react to trade policy. I mean, there was some thinking that maybe they were underestimating effects, but I think reality is sinking in. We're seeing the equity markets move around. We're seeing yields move around, spreads move around, as I think everybody sort of digests what's coming out of the White House. So it's certainly adding to volatility. We haven't seen it really have a destabilizing effect in Canada so far, but that's something we'll watch closely. But these are questions that we'll definitely dive deeper on in May when we put out our financial stability report.
Okay, that's it for the room here in Ottawa. We're going to go to the reporters who have joined us remotely now. I'll just remind you, if you're on the line, come off mute only, please, to ask your question, and then go back on mute as soon as you have finished, so that everybody can hear the response. I'm going to start with Alicia Sikirska from Yahoo Finance, please. Go ahead, Alicia.
Thank you for taking my question. You said that the economic impact could be severe. So how should Canadians prepare themselves financially and otherwise for that?
I mean, I think what we're seeing in the survey data is Canadians are preparing themselves. We're seeing saving rates go up, discretionary spending go down. These are the kinds of things that are going to feed through and have an impact. I mean, we are seeing concern around job security. I mean, I think that's probably what's leading to the decisions around spending and saving. I think Canadians are responsible. They're reading the news. They're watching this with the same level of concern we have, and they're preparing in the best way they can.
I would just add, what we can do and what we have been doing is to provide analysis of what this could look like. Obviously, there are many scenarios. Trade policy is shifting every day. There's a lot of unpredictability, but we have been publishing various scenarios. We published one in the Monetary Policy Report. I published another one. We published another one in the speech I gave a couple weeks ago in Mississauga. Today we published the survey evidence so everybody can see what we're seeing. Look, we can't make this go away, but at least by providing some analysis about what it could look like, that can help Canadians prepare.
And what we know Canadians don't want, on top of all the uncertainty coming out of the U.S., is another spout of inflation. So that's what we're determined to head off.
Okay, next I'm going to call on Max Sato from Mace News, please.
Good morning, all. My question is for both of you, Governor and Senior Deputy Governor. Under the current market conditions with the threat of a global trade war, could we say it is better to have a stronger Canadian dollar than a weaker one for households and businesses from the viewpoint of keeping import costs lower, or do we also have to watch out for the negative impact of a stronger Canadian dollar on exporter profits?
Well, maybe I'll start off here. Well, first of all, I just want to remind you, we don't target the Canadian dollar. In fact, the flexible exchange rate is part of our monetary policy regime. It is what allows us to gear monetary policy to the needs of the Canadian economy, the needs of Canadians. The dollar is determined in markets, it fluctuates. And as I said in previous questions, what you're seeing in the dollar is reflecting what's going on. It has depreciated, and that largely reflects the continued threats by the U.S. administration of significant tariffs. I don't know, do you want to add much?
I think we've said a lot about the U.S. dollar, Canadian dollar right now.
Okay, I've got 3 questions left. I'll go now to Anna Pereira from the Toronto Star.
Hi, good morning. So I know you've already addressed much of this today, but I wondered if you could expand on the mechanism through which you see tariffs pass through to consumer prices. In your scenario from January, most of the pass-through happens in year 3, but as we saw during the pandemic, businesses can adjust costs quite quickly, especially related to supply chain. So why not sooner, and are you prepared if it happens more quickly than expected?
Well, it's a very good question, and well, the reality is there's a lot of uncertainty about that, and we are concerned, but that's why we're tracking it, but perhaps you want to expand on that.
Yeah, I mean, the speed of pass-through and the magnitude of pass-through are 2 of the big questions, the big uncertainties. Our models give us a way to analyze that, but they're not a crystal ball. We can't predict with certainty. I mean, you're drawing a comparison to the pandemic, and I think there are some similarities. I mean, a trade war is a supply shock. It's going to disrupt supply chains. It's going to affect production costs and production capacity. So in that sense, it's similar to what we saw in COVID. What is different, though, is the supply constraints in COVID ran headlong into a surge in demand as we all came out of lockdowns and we had a lot of pent-up demand for goods and services. So the economy was running really hot at the same time as we had supply constraints. And that was an environment where businesses could pass through price increases really quickly, and that's what we saw. What we expect in a trade war is more likely is we will see lower demand, and you see that really in the survey data that we were just talking about. Canadians are planning to spend less. They're worried about job security, so we don't expect that the supply constraints from the tariffs and the trade war will run into the same surge in demand we saw. So that could mean that we don't see the speed or the magnitude of pass-through to prices. But as the governor said, that's a big question. We'll be watching it carefully.
And the only thing I would add is that it depends exactly on what the good is. On things like fruit and vegetables, for example, if you're buying fruit and vegetables from the United States, you'll probably see pretty rapid pass-through on something like that. These are perishable goods. On more differentiated, more durable goods, you might expect to see slower pass-through. So when I say we're tracking it, we have to track it by different good categories, and then we have to come to some overall assessment, and that's going to take some time.
Okay, I'll go now to Rob McClister from Mortgage Logic News. Go ahead, Rob.
Good morning. Longer-term inflation expectations are obviously critical, but short-term expectations usually react quicker, and they're rising as we speak. So given it's hard for people to make predictions far into the future, is there any validity to weighting short-term inflation expectations more than long-term expectations when forecasting inflation trend changes?
Well, I mean, the short answer is, look, we look at them both. But, I mean, given the tariff threats, given the depreciation of the Canadian dollar, given the clear intention of the Canadian government to respond with retaliatory tariffs, you can understand why people's perceptions that inflation could go up have increased. They see there could be some new costs, and that's going to cause new price increases. And as I said to one of the previous questions, actually, monetary policy can't stop that. Some prices are going to go up. What we want to make sure is that those first direct price increases don't knock on to, spill over into other price increases and becoming ongoing inflation. And one of the ways that we look at that is we focus on medium to long-term expectations, because if people begin to believe that the rise in inflation, which is raising short-term inflation expectations, is going to persist, you'll start to see that in their medium and longer-term inflation expectations, and that would certainly be a big warning sign for us.
Et en terminant, passons maintenant à Philippe de Montigny.
Philippe de Montigny, Radio-Canada. Are you there, Philippe?
Et il m'a dit qu'il a voulu une question.
He said he wanted to ask a question. No?
In that case, that will conclude today's press conference. Oh, okay, Philippe, if you can come off mute right now, please.
Philippe?
Okay, we're having a technical problem hearing you, unfortunately, so we'll have to get you the next time. Apologies for that. That will conclude today's press conference. Thank you to the governor and senior deputy governor. Thank you all for joining us. We'll see you in about 5 weeks.